Hi everyone. So let me just add a couple more things. Here we go. All right, welcome. So today I was going to review the first part of macroeconomics. All right, I'm just quickly making sure I have everything that I need so that I don't forget. And then we will begin. Just give some people a chance to join. So, all right. So, hi everyone. It's good to see you all once again. Today, as I mentioned earlier in the community tab, I'm going to be reviewing the first part of macroeconomics. So how is economic activity measured? Okay. Now, the real world issue in this case, and this is something that you really need to think about, is basically why does economic activity vary over time and why does this matter? Right? So in order to really be able to answer this real world focus, we need to actually, okay, well, how do economists measure economic activity? How do economists know whether the economy is in a state of recession or in a state of inflation? There has to be a way by which economists measure economic activity. Okay, so this is what this part will be about. Next week at the same time, I'm going to be doing aggregate demand and aggregate supply. Okay, so next week will be the aggregate demand and the aggregate supply review. All right. Some students really struggle with the whole difference between the Keynesian and the new classical model. So that will be the focus on next week. But this week, I really want to start with measuring economic activity. How is it measured? And why does it matter how economic activity is measured? All right, so we start with the circular flow. All right, the households, the circular flow divides the economy into 5 main sectors. Okay, you've got the household sector. These are the owners of the FOPs. Okay, so remember, they are the owners of the factors of production. They own the land, the labor, the capital, and the enterprise. The firms or the businesses are the employers of the FOP. They are the ones that employ. Okay, so we don't divide them into consumers and producers because that focuses too much on individuals. We look at institutions. The household sector are the owners of the FOPs. So what the household sector does is they give their FOPs, okay, their labor, their land, their capital, and their enterprise. They give that to the firms. In return, they receive factor incomes, okay? So labor, the owners of labor receive wages. The owners of land receive rents. The owners of capital receive interest. And the owners of enterprise receive profit. okay? This is the first flow. This is like the factor flow, factors of production flowing from the household sector to the business sector, and in return, they get the factor incomes. Now, what does the business sector do with these factors of production? Well, the business sector takes these factors of production and produces basically output of goods and services. And in return, households spend money, expenditure on goods and services that comes back to the business sector. Okay, so these are the two main flows: the output flow, the factor flow, and the income flow. All right. Now, with the expenditure flow, we add leakages and injections. Okay, so there are three leakages: saving, taxes, and spending on imports. These three in green are the leakages. And there are three injections: investment spending, government spending, and export revenue. These are the injections. Okay, so not all the income that is received by households is actually spent on goods and services. Some of this income flows to the financial markets and the banking sector in the form of saving. Some flows to the government sector in the form of taxes. And some flows to other countries or the foreign sector in the form of spending on imports, which, remember, is called import expenditure. That's its like fancy name. Okay, so these are the three leakages, but each leakage has a corresponding injection. All right, the money that's in financial markets, that's in the banking sector, goes back to firms in the form of investment expenditure. The government, even though it takes our taxes, it injects it back into the economy in the form of government spending or government expenditure. And we also get money from other countries when they buy our goods and services. That comes back in the form of what we call export revenue. So foreign countries spending on our exports. Okay. Now, the three approaches to measuring GDP or to measuring national income can actually be derived from this circular flow. Okay, there are three approaches to measuring GDP. All right, so first of all, three approaches to measuring national income or measuring GDP. The first one is the output flow, or the output approach. The output approach is basically, in theory, in oversimplified terms, it's the total revenue of all firms in the economy. Total revenue is price times quantity. So it's P1, Q1 plus. That's the total revenue of firm one. Okay? P2, Q2 plus all the way plus to Pn, Qn. So basically, what's happening is the government is totaling up all the total revenue of all firms in the economy. That's the output approach. So this focuses here on this arm or on this arrow. That's the output of goods and services. That's the first approach to measuring the GDP or national income. The second approach is the income approach. That looks at the total income generated by all factors of production. Okay, so the total wages, W, plus total interest, I, plus total rent, R, plus total profit, okay, generated within that accounting period, whether it's 3 months or a year. Okay, let's just say within a year. Okay, total wages received by owners of labor, interest received by owners of capital, rent received by owners of land, and profit received by the entrepreneurs. That's the income approach. That is this arrow here. This arrow here that flows from the business sector to the household sector in the form of factor incomes. Okay, and then there is the slightly more complicated one, which is the expenditure approach. The expenditure approach is basically the same formula as aggregate demand. Okay, the expenditure approach measures GDP as C plus I plus G plus X minus M. Okay, what is C? What is I? You might be asking. I'll definitely answer those questions. C, okay, so C is all the consumer expenditure. I'll change the color to brown. C is all the household expenditure on goods and services. That's C. I is the total investment spending coming from financial markets to the business sector. That's I. G is the total government spending coming from the government sector to the businesses. That's G. X is all the export revenue that the country receives from other countries. Minus M is the import expenditure, okay, that leaks out of the economy. So the only leakage that we actually include in this approach, the expenditure approach to measuring GDP, the only leakage that we actually include is import expenditure, okay, because that's money that flows out. So this is the expenditure approach, C plus I plus G plus X minus M. Now, in theory, the output approach, the income approach, and the expenditure approach, they are three approaches to measuring the same thing, right? So in theory, they should yield the same result because you're ultimately measuring the same thing. Now, obviously, in practice, that does not always happen. Why? Because some data is unreported. There's an underground, informal economy. There's illegal activity. In practice, they don't yield the exact same number. That's why there are statistical discrepancies. Okay? But the expenditure approach, you know this formula, you'll see it later, is basically looks at aggregate demand, while the output approach is basically aggregate supply. All right, in theory. Also, aggregate supply is the income approach because how much output you produce is basically how much income is generated. Okay, so just something to keep in mind. Now, obviously, questions in this session are open to the members of my channel, right? So in those sessions and in the future, if you'd like to ask questions and chat with me during the session, this is a privilege that is open to members. You can find all the links to support the channel, become a member, buy me a coffee, all the links in the description below. I would encourage you to become a member because I think these review sessions are very useful to members, subscribers, and everyone who's watching. But asking questions and being able to interact with me is a way to help you review. Okay? All right. So I've just reviewed the three approaches to measuring GDP. Okay, so I talked about national income as a measure of economic activity. I talked about the equivalence of the income, output, and expenditure approaches with reference to the circular flow, and I've done the circular flow. All right, so let's talk about GDP and then all the adjustments that are made to GDP. So GDP is the total money value of all final goods and services produced within an economy in 1 year. Okay, so total money value of all final goods and services produced within is a very important key term, an economy in 1 year or 3 months. GDP is measured every quarter, by the way, but it doesn't matter in 1 year or the point is you have to have a beginning and an end of the time period you're measuring GDP. So what are the key terms here? First of all, it's a money value. So it's expressed in money terms. Final means it excludes all intermediate goods and services, right? Intermediate goods and services are already reflected in the money value of that final good or service. Produced within, anything produced within the borders of the economy, okay? It doesn't matter if the producer is a citizen of that nation or economy or not. Okay, so if you're measuring the GDP of the United States and there are Chinese companies in the United States, they will, their output will be included in the United States GDP. Okay, regardless of whether or not they are citizens of the United States. Also, if you have American companies overseas outside the United States, like say in China, their output is not included in American GDP. Why? Because their output is not within the economy of the United States. This is very important to keep in mind because make it easier for us to understand G and I. So how do we measure GDP? Again, the three approaches. I said the output approach, the income approach, and the expenditure approach. However, GDP is not a perfect measure. So we make some adjustments based on what we need from this national income statistic. Okay, so what are some of those adjustments? So basically, adjustments to GDP to get a more complete picture of the level of economic activity or the performance of the economy. The first adjustment number one, is from GDP to GNI. Okay, remember how I said GDP focuses on the location of production. Where is the production taking place? Okay, GNI, on the other hand, focuses on the nationality of this production. Okay, so GNI is equal to GDP. Take that GDP, and then you add any income generated by citizens living abroad. All right, any income generated by citizens living abroad, and you subtract any income generated by foreigners living in the country. Okay, so if you're going to get the GNI of the United States, you basically take the GDP measurement, and then you add any income generated by American citizens that are living abroad. Remember, this income could be wages or interest or rent or profit. It doesn't matter, but it's any income generated by Americans living abroad. Any wages earned by Americans living abroad, any interest by Americans living abroad, any rent payments made to Americans, any profit, okay? And then you subtract any income generated by foreigners living in the country. Again, that's wages, interest, rent, and profit. What that does is it focuses on, okay, it focuses more on who is generating the income rather than where is the income being generated. So GDP focuses on where, GNI focuses on who is generating this income. Okay, now these two together, if you put them within what's it called, like a bracket or parentheses, that's called the net property income from abroad. So to give you an example, I live in the United States, but I'm not American. I'm an Australian citizen, actually. Okay, my salary and my income is generated within the United States. So it would be included in American GDP. So the GDP of the United States would include all of my income. Okay, but the GDP of Australia would exclude my income because I don't live in Australia. My income's not generated in Australia. However, when America is calculating its GNI, it would exclude my income because I am not American. I live here and I work here, but I am not a citizen. I'm here on a work visa. Australia, on the other hand, would include my income in Australian GNI. Okay, so just to give you an idea. Now, this applies to all sorts of income: wages, interest, rent, and profit. Okay, now you might be thinking, well, how do they know this? Well, because if you think about it, we report our incomes to governments and our citizenships all the time, right? When you fill out a tax return, right, the government knows your citizenship status. The government knows the income you're making. And even in Australia, I have to report my income to show that I'm paying taxes in the United States so that I don't have to pay taxes in Australia, and so on. So this data is available. Now, obviously, there is missed data. There's income that's generated that's not reported, and so on. But generally, that's how it's calculated. So that's the first adjustment. All right, what's the second adjustment? So the first adjustment is from GDP to GNI. Okay, we did this. So here we go. The second adjustment is, this is adjustment number 2. The second adjustment is from nominal measurements to real. Okay, whether it's GDP or GNI, it doesn't matter. This adjustment you can make to GDP or GNI. What's the difference? Well, nominal is any measurement that is not adjusted for inflation. Meaning, not adjusted for inflation meaning it is using current prices. Real, on the other hand, is adjusted for inflation, meaning it is using fixed prices. Okay? Say, for example, you are comparing the GDP from 1950 to today. That's a 70-year difference. Obviously, in those 70 years, prices have changed. They've risen, right? They've risen dramatically. So you can't compare the raw or like the nominal GDP of the US now with the nominal GDP of the US in 1950, right? Because that's going to give you this impression that, wow, GDP has grown dramatically. But once you eliminate the effect of inflation, okay, and you're comparing real figures, so remember, this adjustment allows for comparisons over time. That's why we make this adjustment, okay? When our goal is to compare over long periods of time, we convert nominal measurements to real measurements. That's when our goal is to make those comparisons, okay? So to allow for comparisons over time, we take this nominal, so real GDP is basically equal to nominal GDP, or GNI, by the way, divided by something we call the GDP deflator times 100. Okay, so how do you calculate this? Well, basically, you will be given either nominal GDP and the GDP deflator, and you have to calculate real GDP, or you might be given the GDP deflator, real GDP, and you have to calculate the nominal. You just rearrange the equation. It doesn't really matter. Okay, so that's adjustment number 2. Why do we make it? To allow for comparisons over time. Adjustment number 3. Adjustment number 3. Okay, and this is to allow us to compare between countries. Okay, adjustment number 3 is from total GDP or GNI to per capita. This is basically to adjust for population size. Remember, adjustment number 1 from GDP to GNI is to adjust for location. Where is this production or this income being generated? Adjustment number 2 is to adjust for inflation. To adjust for inflation. That's adjustment number 2. Adjustment number 3 is to adjust for population size. Okay, so GDP per capita is basically, not capital, capita, I always write the L by accident, I'm not thinking, is equal to total GDP, the GDP that you measured using the output, income, or expenditure approach, divided by population. Okay, that's the total GDP per capita. GNI per capita, by the way, is exactly the same. Okay, it's total GNI that you calculated using the first adjustment here, divided by population size. And this adjustment, to adjust for population, why do we do it? To allow for comparisons between countries. So the second adjustment here from nominal to real is to allow for comparisons over time. This adjustment is to allow for comparisons between countries. So usually to compare between countries, we take real GDP per capita, or real, so it's already adjusted for inflation, GNI per capita. That's to compare between countries. Now, the last adjustment you kind of have to understand, so this is adjustment number 4, the last adjustment you have to understand, but there is no formula for it. You don't have to actually calculate it. And this is from, again, I don't know what the, so basically it's adjusting for cost of living, right? Using what we call PPP, purchasing power parity. Okay, PPP, purchasing power parity. And this is because if you want to compare GDP per capita of the US with the GDP per capita of China, life in China is much cheaper in general than life in the United States, right? So you have to adjust for these differences in cost of living. You either have to deflate GDP in the US to be able to compare it to China, or you have to inflate GDP in China to be able to compare it, okay? So there is no calculation for this, but let's just imagine. So let's just imagine GDP. I'm pulling numbers off the top of my head, by the way. These are not accurate, whatever. But let's GDP per capita in the USA is $60,000, while GDP in China is, say, $20,000. Okay. If you're going to compare these two values, it might appear that on average, the American worker earns 4 times. Remember, 60,000 is, 3 times, not 4 times, 3 times as much as the average Chinese citizen. Okay. However, when you adjust for cost of living, what if I told you that life in the United States is twice as expensive as life in China? So you can basically cut this in half to 30,000 using China's cost of living. That's a more accurate measurement. Now it appears that when you adjust for cost of living, you allow both countries to use the same cost of living. The average US citizen makes about the equivalent of $30,000 in China, while the average Chinese citizen makes about 20,000. Okay, that allows for a more accurate. So you can see here that the American worker on average is only 1.5 times richer, or generating 1.5 times more income than the Chinese citizen. By the way, you can also make the adjustment the other way around. So remember, I told you, let's imagine that the cost of living in China is twice as expensive as the cost of living in the United States. Well, you can then double this instead. So instead of this being 20,000, using US cost of living, it would be around, so 20,000 in China is the equivalent of 40,000 in the US. Again, you have the same value. You can see that the average US citizen is only 1.5 times as rich as the average Chinese citizen. So it doesn't matter which direction you make the adjustment. Now, there is no formula for this. I just want you to get the idea. One very famous PPP index is the Big Mac index, okay? Which it's really, basically, it's an index that looks at the cost of the Big Mac. How much does a Big Mac, what's the price of the Big Mac to buy in every country around the world? And that helps us give us an idea, because it's the same product, the Big Mac by McDonald's, it's the same everywhere. But seeing how much, if a Big Mac in the United States costs $1 and in China it costs 50 cents, right? Then in general, that means that life in China is half, the cost of living in China is half that of the United States, or whatever. That's one way of adjusting for PPP measurements. All right. So now we've talked about, let's see, we've talked about real GDP and real GNI. We've talked about per capita and purchasing power parity. That leaves us with the business cycle, which is the other diagram here in this unit. And there we go, the business cycle. So the business cycle, what it does is it tracks output, like real GDP. So it's already adjusted for inflation over time. Okay, and there's a long-term growth trend, or a long-term line, and short-term fluctuations. Okay, so the long-term trend is that there is growth in the nation's potential GDP, or potential output. That's the long-term trend. Okay, but in the short term, this growth is not very uniform. There are fluctuations. The economy goes through periods where economic activity peaks. Okay, you could call this a boom. Okay, and then it starts to slow down, and it goes through a trough where you have a slump in economic activity. And then you have periods of expansion. This expansion peaks, and then economic activity contracts, and so on. So during a boom, you see inflation increasing and unemployment decreasing. All right. And during a slump or a trough, you have a recession, which is the opposite. You have inflation decreasing and unemployment increasing. Okay, so this is to kind of prepare you for what's coming next, right? Economies are either experiencing periods of inflation or periods of recession. During periods of inflation, the unemployment rate is low, but the inflation rate is high. Economic activity rate is high. Okay, economic growth rate is high. During periods of recession, economic growth rates are low, unemployment rates are high, inflation rates are low. Okay, these are the now all economies experience business cycles, but what governments try to do is they try to prolong periods of expansion by managing the inflation so that it doesn't get out of control, and they try to shorten or soften periods of recession. Okay, so ultimately what governments try to do is they try to manage economic activity so that periods of expansion or booms are prolonged and periods of recession are shortened. Okay, so this is the business cycle diagram. Again, you just need to know that there are short-term fluctuations and long-term growth in potential output. Here, we need to also distinguish between actual output and potential output. Potential output or potential GDP is what the economy is basically capable of producing. Okay, this is the productive capacity of the economy. All right. Actual output is what the economy is actually producing. So this solid line here is what the economy is actually producing. Okay, so why is this relevant? When actual output is greater than potential output, the economy will be overheating, which means the main concern of the government will be inflation. Inflation is the main concern. When actual output is less than potential output, the economy is basically slowing down. Okay, there is a recession, which means the biggest priority would be the unemployment rate. So during periods of recession, the biggest priority is unemployment. During periods of inflation, obviously the biggest priority is inflation. Okay, so something to kind of keep in mind. Okay, so we just did. Now, here I'm just going to talk about the appropriateness of using those statistics. First of all, GDP and GNI statistics, remember, they allow us to compare economic well-being and measure economic well-being and compare between countries. But comparisons over time can only be done if we use real measurements, okay? Which means to be able to compare over time, we need to adjust for inflation. And that's why we make that adjustment from nominal to real. To be able to compare between countries, we need two adjustments. First of all, we need to adjust for population size, which is why we use per capita measurements. And we need to adjust for cost of living differences, right? Which is why we use PPP. So therefore, the most appropriate measure to allow us to compare between countries is real, GNI, per capita at PPP. This basically, you have adjusted for citizens, right? You have adjusted for population, you have adjusted for inflation and cost of living. So real GNI per capita at PPP is really the one that allows us to give us the most accurate way of comparing between countries. Now, there are alternative measures of well-being. There are many, by the way, but you only need to know these three. So I would suggest that you go check the glossary, get the definition, and know how these. So the OECD Better Life Index, that's very limited because it only looks at the OECD countries, which is basically a club of rich countries. The Happiness Index focuses more on quality of life. Remember, standard of living. So GDP per capita measures the standard of living. It's very material. It only looks at how much goods and services can people consume in a period of 1 year. It's a very limited measure of economic well-being because standard of living does not equal quality of life. I always tell my students this. Remember, standard of living does not equal quality of life. Just because the standard of living in this country or economy is high doesn't mean all citizens are happy. Quality of life is more multidimensional. It looks at things like crime rates. Are they low? Divorce rates, are they low? Suicide rates, are they low? Access to education and healthcare and basic necessities. Freedoms, are people free to express themselves and so on? So quality of life is more multidimensional. This will tie in when we get to the development economics unit. Okay? Standard of living is very material, right? It just looks at access to goods and services. Okay? It's how much money people are making on average. But quality of life is more multidimensional. And therefore, when you look at the happiness index and the happy planet index, you see that the richest countries aren't always, yes, definitely, being a richer country allows for a better quality of life. But richer countries aren't always the ones with the happiest citizens or the best quality of life. This is something to keep in mind. And that's why we use these alternative measures of well-being. Now, this is only an assessment objective too, which means you really need to be able to just explain these, but you don't really need to be able to talk too much about them. It's a very sort of low level. And there you go. So this real-world issue is, why does economic activity vary over time, and why does this matter? And we've basically looked today, we've just looked at, well, how is economic activity measured? Next week, I'm going to review aggregate demand and aggregate supply, and changes in aggregate demand and aggregate supply. And we'll see why changes in aggregate demand and aggregate supply actually affect the economic well-being of people. Remember, changes in the condition of demand and supply, here they're talking about aggregate demand and aggregate supply, cause economic activity to vary over time, okay? And these fluctuations in economic activity impact the economic well-being of people living in this economy as well as societies. And there are different schools of macroeconomic thought that identify different causes and different solutions for macroeconomic problems. Okay, so we're going to look at macroeconomic problems like goals and macroeconomic objectives like low unemployment, low and stable inflation rate, high economic growth, and so on. Okay, and there you go. That was a quick 30-minute or so review of how is economic activity measured, and the business cycle and the different adjustments that we make to those measurements of economic activity. Anyway, it's been great. Every week I will try to review a different part of the syllabus. So go to the communities tab and follow, because I usually try to poll people what they want me to review. I imagine that some people will want me to review aggregate demand and aggregate supply, and that's why it will be part of the poll. And please check the description below, all the ways you can support this channel. You can become a member, buy me a coffee, subscribe. Please hit subscribe. A lot of people watch and they don't hit subscribe. Subscribing and liking the videos and commenting on the videos is one of the best ways to boost engagement and let the algorithm basically recommend my videos to others. All right, it's been great. Thank you all, whoever attended, and I hope you find this useful. Have a great rest of your weekend. Bye.